does interest on a reverse mortgage work? It's an important part of understanding how your loan balance and home equity may change over time. With Heartland Bank's no negative equity guarantee, you'll never owe more than what your home sells for. Here's Heartland Bank team member Forbes to explain how interest adds up over time.
If you're aged 60 or over and own your own home, a reverse mortgage can help you access some of your equity without the requirement to make regular payments. However, you can make voluntary repayments whenever you like. But how does the interest work? And what does that mean for the equity you hold in your home? Let's take a look. A reverse mortgage has a variable or floating interest rate. This means that it goes up or down as market conditions change. Interest is calculated daily on your loan balance and added to the loan at the end of the month. Because that interest is added to the balance, the following month's interest is calculated on a higher amount. This is called compounding interest. For example, if your loan balance was $100,000 and the floating interest rate for the month was 8%, the interest accrued over the first month would be around $667. Because regular repayments are not required on a reverse mortgage, that $667 is added to the loan on the monthly anniversary of your drawdown. And next month's interest is calculated on the new, higher balance of $100,667. The loan is ultimately repaid when you sell your home. Now, let's look at a different example to show you how this could impact your home equity. Let's take an initial reverse mortgage loan balance of $80,000 and assume the floating interest rate is 8% on average over the life of your loan. So long as no voluntary repayments are made, the loan balance will grow over time due to compounding interest. What happens to your overall equity depends on how your home's value changes over the same period of time. So let's look at two different scenarios set over a 6-year period. If your home increased in value by 3% per year over 6 years, a home worth $750,000 would be worth around $895,000. This means your net equity in the property, the difference between the value of your home and the balance of your loan, will have increased to around $765,000. If your home didn't grow in value at all over those 6 years, it would still be worth $750,000. However, because the balance of your loan has grown, your net equity will have fallen to roughly $620,000. How your equity changes depends on how much you borrow, how long the loan is in place, changes in interest rates, whether you make voluntary repayments, and how your home's value moves over time. Check out our reverse mortgage calculator on our website, and we encourage you to contact us to run custom calculations for your needs.
Heartland Bank's market-leading reverse mortgages have helped over 26,000 Kiwis unlock the possibilities of retirement. To learn more, get in touch with Heartland Bank.